The current housing market nationally is seemingly in a very strong growth phase. Australian broker caught up with Tim Lawless of RP Data to ask him if he thought this kind of growth was sustainable and what cities are driving it.
Well, a really simple answer to the question is no. You wouldn't expect dwelling values to continue growing at 12% per annum. That's unsustainable. You'd expect a sustainable growth rate is going to be broadly in line with household income growth, which is tracking around about 5% year on year at the moment. But much better way to look at the housing market is not just in the current cycle, which is clearly a very strong growth cycle, but it's over a longer term, because the marketplace does go through growth, goes through stability, it goes through declines, as it has over the past decade. And actually, over the past 10 years, we've seen dwelling values only increase by 4.5% per annum year on year. Yeah, so there's really two cities that are the key drivers of very strong growth at the moment, and that's Sydney and Melbourne. And you could even swap those two around, because Melbourne over the last 5 years has been a much stronger performer than what Sydney has. So if you look at Melbourne, since 2007 we've seen dwelling values rise by about 65% across that city. At the same time, rents have only risen by about 25 to 30%. So we've seen a real destruction of yields in the Melbourne marketplace. The typical house is yielding about 3.3% gross, which in my view is quite unhealthy and probably demonstrates that marketplace is potentially overvalued. Sydney's also showing very low yields, but hasn't shown as strong a growth over the previous two cycles. But absolutely over the current cycle, Sydney's seen, since the beginning of June 2012, when the growth cycle started, Sydney values are up by a little bit more than 20%. So once again, looking at sustainability over the current cycle, values are getting very high, and I think we're already starting to see natural affordability barriers in that marketplace, as well as the fact that yields have moved very low in both Sydney and Melbourne.
So what can and should brokers be doing to capitalise on this?
Well, I think any broker should be paying attention to all the segments of the marketplace. It's broadly, you can look at investors and you can look at owner-occupiers, and of course you can start drilling down those segments, like peeling back the layers of an onion. We're really seeing the premium end of the marketplace firing now, so much more so than the more affordable end of the market. We're also seeing the fact that because values have risen so much, we're really seeing an equity level being built up in key cities like Sydney and Melbourne, which brokers probably need to start targeting a lot more, identifying where those properties are that have a substantial equity build, and speaking to those owners about how they can leverage the equity that they've accumulated in their property, either through leveraging into other investments or refinancing, looking to improve their asset base. That type of thing is probably the key thing that brokers could be looking at. Investors, I think, are probably around peak levels at the moment, with the fact that yields are so low in Sydney and Melbourne. I wouldn't be surprised if we start seeing investor demand really migrating away from those cities and towards potentially, say, Brisbane or even Adelaide, where yields are much better and those markets are much earlier in the growth cycle as well. So for brokers to understand those trends and understand where the changes in demand levels are likely to be flowing from and to, I think that should also be a key part of their strategies, at least at a very high level.